For years, investing in Venezuelan bonds has been a popular play for the world's largest investors, seduced by mouth-watering interest rates, despite the obvious risks. Now, as the bonds have plunged in value over fears that the Venezuelan government will finally default on its bond payments, many traditional investors are heading for the exits, replaced by a hardier band of funds that specialize in the debts of near-bankrupt nations. With steel stomachs and having survived numerous Byzantine debt dramas, from Argentina in 2000 to Greece in 2012, they see Venezuela as the next great debt restructuring payday. It is all about the price, said Lacey Buckheit, a debt specialist of 30 years standing at the law firm of Cleary Gottlieb Steen and Hamilton. If you look at the behavior of distressed investors, they wait for the price to hit a certain threshold, usually 20 cents on the dollar, and we have now reached that. Developments have moved quickly in recent weeks, with a call to restructure, missed interest payments, a default on a power company's bonds and an inconclusive meeting with investors on Monday. But neither Venezuela's sovereign debt nor that of its national oil company has been declared in default by creditors, though Standard & Poor's says the conditions exist for a default. Investors taking the long view still believe that the government will find a way to keep paying what it owes. Their calculation, Mr. Buckheit said, is simple: whether the price of the bonds is below what might be recovered through a debt restructuring agreement or as part of legal enforcement if Venezuela refuses to negotiate. With the country's political and social disarray, United States sanctions, and recent demands from the government of President Nicolas Maduro that bond investors agree to a debt deal, Venezuelan bonds have plunged in price from over 30 cents to the low 20s. According to the data-gathering firm FactSet, established firms like Goldman Sachs, Fidelity and T. Rowe Price still sit on about $3.5 billion worth of bonds issued by the national oil company Petróleos de Venezuela, or PDVSA. By far, these have been the favorite bonds for foreign investors because the company is seen as the country's cash cow, with its steady stream of foreign exchange earnings and its wealth of overseas assets. But as the Venezuelan economy continues to deteriorate, the risks of owning these bonds have grown significantly. The country's foreign exchange reserves have fallen below $10 billion, a level economists say comes close to insolvency, and experts say striking a debt deal will not be easy, especially with an unpopular government and dueling legislatures. And so the selling has begun. We have significantly reduced our portfolio in Venezuela over the past year, said January Den, the head of research at Ashmore Investment Management, an emerging market specialist based in London. This is a slow-moving train wreck. For these experts in distress, or vulture investors, it is at this point that they get serious about committing funds. And those who have been through many such situations say Venezuela could become the most profitable of all.